SoundHound's latest earnings is causing the stock price to drop as there were a few things investors should be concerned about. But here's something pretty exciting. They just hit a milestone of processing over 100 million AI-powered restaurant calls. Oh, and speaking of calls, if you want to avoid awkward phone conversations like me, hit that subscribe button and let the AI handle all your food ordering needs. Alright, all jokes aside, let's get started, and at the end I'll share my thoughts on whether I buy or pass on this interesting but volatile AI play. Also check out the pinned comment for special offer at fool.com/Jose and a special coupon for my earnings ebook.
I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
All right, so let's break down what's happening with SoundHound's Q3 earnings and why the stock has dropped after reporting. First, if we take a closer look at numbers, on the top line, things look amazing. Revenue came in at $25.1 million, up 89% year over year. GAAP loss, unfortunately, of 6 cents per share, adjusted EBITDA loss of $15.9 million, cash position of $136 million, and on the good side, they updated their 2024 guidance and they continue to see strong growth in 2025. So what went wrong? Well, there are a few things that caught investors' attention. Number one was margin pressure, and oh boy, this is a big one. Their GAAP gross margins dropped from 73% last year to just 49% this quarter. Even the non-GAAP margin fell from 74% to 64%. That's not exactly what you want to see from a high-growth tech company. The main reason for this is the Amelia acquisition, and that overall came with lower margin professional service, higher cost escalation support services, and integration costs eating into, I want to say profitability, but eating into that income overall. Now, during the Q&A session, CFO Nitesh admitted that they're still evaluating which business segment to keep, saying that the professional service is actually strategic, and they think that the question isn't binary in or out, it's more about where and how. And this is something that when they got the earnings, it was going to take a few months for them to decide what part of this acquisition were they going to keep and what part were they going to throw out. The second thing is concerning cash flow metrics, which is creating pressure on the company's balance sheet. They used roughly $75.8 million in operating activities over the past 9 months. That's up from $54.4 million last year. And remember, I mentioned that the company only has about $136 million cash on hand, and they have about $30 million in debt at about a 15% interest. So with that cash flow in 9 months, with the amount of cash in their balance sheet, at this current burn rate, it definitely has become a concern and is driving concern to the third point, dilution concerns. The company announced a new at-the-market equity program, which basically means they might sell more shares. While their CFO mentioned that it's to help pay down their 15% interest debt, investors generally don't love the possibility of dilution. Now let's dive into something really interesting, questions from the earnings call that help us understand what's really going on. So the first question comes in about the Amelia acquisition. 3 months ago, when they mentioned the Amelia acquisition, they talked about looking at various parts of the business to decide which ones they're going to incorporate and which one they're going to kind of pretty much throw out. Can you kind of give a sense for how much of the Amelia business you're going to be retaining? And the CFO responding was pretty telling. They're still figuring out, but here's what they're keeping: the convergent AI space, voice enablement capabilities, AI ops solutions for employee-facing operations. But here's where things get very interesting. They're still unsure about the professional service because it's a lower margin business, the escalation support services as well, and this uncertainty about business segments might be contributing to some investors' concerns about maybe saying, hey, look, management doesn't necessarily know what to do with this acquisition they recently made. The second was a big question about technology foundation. So someone came in and kind of asked about their Polaris foundational model, if they can help them understand how they benchmark that model and what the important benchmarks are, how many parameters was it trained on. The CEO's response revealed some key insights. They've been building models for almost 2 decades. They claim to consistently beat big tech in accuracy and speed. Interesting point about hallucination rates. While OpenAI might be okay with 20 to 30% hallucination rates for consumer application, SoundHound needs much higher accuracy for enterprise customers. Now let's talk about some of the positives because there's definitely growth potential here. Number one is customer diversification. This is actually pretty impressive in my mind. Their largest customer now represents only 12% of revenue, down from 72% last year. That's a huge for reducing risk. Now their top 5 used to be 90%, now it's less than 1/3. They're also seeing huge restaurant momentum. They signed 7 of the top 20 quick service restaurant brands globally. During the call, CEO mentioned that they are winning new logos and they also believe that they are the leader in AI for restaurants. Automotive expansion is another growth opportunity as they're making moves in the EV space, working with 4 manufacturers and already live in 2. Plus, they got some interesting partnerships in China through Dian Tech. They also mentioned new growth opportunities. Number one is healthcare expansion. They signed various health for patient engagements, working with multiple insurance companies and integrating with companies like with dentists and other types of doctors for appointments. In the financial service, they're working with 7 out of the 10 financial institutions globally. They have new partnerships with credit unions, and they focus on both consumer service and employee assistance. Now, looking forward, they did raise their 2024 guidance to 82 to 85 million. And not only that, they provided 2025 guidance of roughly 155 to 175 million. At the midpoint, that's almost a 100% year-over-year growth and targeting adjusted EBITDA profitability by the end of 2025. Now, just a quick recap why investors might be worried. The first is just that huge cash burn. Use 75.8 million in operating activities over 9 months and may need more capital because they only have about 136 million cash position. Integration risk, still figuring out which Amelia segments to keep, potential restructuring cost, and unclear timeline for synergies. 3, competition is heating up. Big tech increasingly focused on voice AI. Restaurant tech space is getting crowded and the automotive competitors are advancing their solutions. Now here's my take. Look, there's definitely growth potential here, and the restaurant AI business is showing real traction. But personally, I'm passing down on this one for now, and for 3 main reasons. First, I believe the competitive landscape is intense. If you're seeing a lot of these open source and kind of just closed solutions in AI voice, that market is growing really rapidly. And while right now maybe they don't have the accuracy and speed as SoundHound, I believe that's only going to take a matter of time. Number 2, valuation does seem pretty stretched out for me. And number 3, I also have a lot of growth exposure in my portfolio, so I tend to be a bit more strict on who I add. But hey, that's just my take. Every investor has a different risk tolerance and time horizons. If you believe in the voice AI future and can stomach the volatility, this could be an interesting growth story to watch. Well, that's it for today's video. Take care and see you for more semiconductor and AI news.